In this video, we'll continue our series talking about each one of our investment strategies. Last week, we talked about our newest ETF strategy, Navigator. Today, we'll talk about our newest individual stock strategy, Sequoia, which we launched in 2021. As we talked about with Navigator, no strategy should exist unless it has a specific reason to exist, a specific goal that it's trying to help people achieve. So let's start with the specific need Sequoia is trying to address. We'll look at this through our security, income, and growth framework. This is the framework we use to design custom portfolios for clients. It's also the framework we use when we introduce new investment models, with each investment model specifically targeting one or more of these three areas. For more details on our security, income, and growth framework, we'd encourage you to check out the video right here. We'll put a link up in the top right of your screen. So you can click on that, and that'll give you more information as to what we mean by security, income, and growth, and how we think about this in the context of your portfolio. In last week's video, we talked about Navigator being a blend of security and growth. Sequoia is entirely focused on growth. We designed Sequoia with the goal of outperforming the S&P 500 index over the long term, which we defined as 3 years or longer. And the key word there is goal. There is no guarantee that any strategy, including Sequoia, will outperform its benchmark over any given period, and especially over shorter timeframes. But this is what we're aiming to achieve. It's also important to emphasize that we designed Sequoia specifically to be a complement to our other strategies. A little over 5 years ago, we noticed that a lot of our clients' objectives were starting to shift away from security and income and towards growth. In some cases, income needs just hadn't gone up very much, or maybe their portfolio value had grown more than their financial plan had predicted it would, or maybe they started thinking about the next generation. There was lots of reasons, but we noticed this was an increasing need for many clients, so we decided to introduce a growth strategy, and Sequoia is what we came up with. The intent with Sequoia was not necessarily to be a standalone strategy, but more a complement to our existing strategies. For example, if we had a client that was in Endowment Cornerstone, with a mixture of our rising dividend cornerstone model and our preservation of capital fixed income model, previously targeting a blend of security, income, and growth, perhaps they wanted to shift a little bit more towards the growth side. So in those cases, we might carve out a portion of an IRA, maybe a Roth IRA, and put that in Sequoia. As a result, their overall household would shift more towards growth and away from security and income. That was an important consideration when we thought about how we should design Sequoia, which we'll talk more about in the next section. So with the goal of maximizing growth, let's talk about how specifically we designed Sequoia to meet that particular need. Sequoia is unique from our other investment strategies in that Sequoia is entirely quantitatively managed. And what that means is that our investment policy committee sets the process and the quantitative filters and algorithm that goes into making Sequoia and choosing the Sequoia stocks. The decision making is all made at the process and rules-based level, and then those rules dictate what stocks make it through. This is the decision-making funnel we use for Sequoia. It starts with all stocks on U.S. exchanges, including ADRs, which are international companies listed on U.S. exchanges. And from there, we use what are called 13F documents to identify institutional investors' highest 50 conviction stocks. And this idea is based on research that was originally published in 2010 and updated in 2021. And the paper was called Best Ideas, updated April 2021 by Anton, Cohen, and Polk. These researchers used mutual fund data from January 1983 through December of 2018. They looked at mutual funds that held at least 5 stocks in their portfolio, and they found that the typical fund put approximately 10.6% weight in their very best stock idea. So the researchers studied the performance of these best ideas, and they found that those outperformed the market and the other stocks in those managers' portfolios by approximately 2.8 to 4.5% per year, depending on which benchmark they looked at. They also found this result was consistent with hedge funds and across different benchmarks, risk models, and different definitions of what best ideas meant. We have our own methodology based on this same concept, where we count the number of institutional investors that have what we define as a high conviction holding in a particular stock. For example, the number one stock from the most recent quarter was Amazon, which had 85 different institutional investors that had a high conviction position in the stock as we define it. The number two stock on the list was Nvidia with 74 institutional investors and so on. So we end up with a list of 50 top stocks based upon those high conviction methodologies. We take those 50 stocks and put them through a proprietary algorithm that we designed specifically for Sequoia. This algorithm seeks to score stocks based on 5 different metrics, each one of them designed to score based on the strength of a company's competitive advantage, CA, momentum, which includes both total return momentum and earnings momentum, and then P for predictability. Taken together, we call these the CAMP scores. We publish these CAMP score sheets quarterly, so if you're interested, you can contact us using the link in the description down below, and we can send you the scores for the most recent quarter. And using those scores, we then select the top 20 stocks that make up Sequoia. We rerun this list each quarter after the 13F filings come out, and those are due 45 days after the end of each quarter. So for example, the Sequoia data we would get starting on roughly February 15th of every year, and then every 3 months following that. So for example, May 15th, August 15th, and the last of the year in November. Each quarter, we rebalance the portfolio back to equal weight, so each one of these 20 stocks would get a 5% weighting. And that means if a company was in Sequoia for 2 consecutive quarters, we would either add to that position if it had underperformed the rest of the portfolio in the prior quarter, or we would sell some of the position and trim it back if it had been one of the outperformers from the prior quarter. We believe that tilts Sequoia a little bit more into a value orientation, so we're buying what did poorly last quarter but still has good scores relative to our algorithm and still has high conviction from institutions, and then we're trimming those positions that did exceptionally well last quarter. One other thing to point out about Sequoia is that it can incur short-term gains. There could be times when we buy a stock in one quarter and then sell it in the next quarter, which increases the possibility of short-term capital gains. So we typically recommend Sequoia for non-taxable accounts like IRAs and Roth IRAs. We've designed Navigator to be our more tax-efficient growth option, so if that's a concern for you, that might be a strategy that's worth checking out. I'll put a link up here if you're interested in checking out the Navigator video. That strategy combines our active management approach with the tax efficiency of ETFs. So if you're looking for something more tax efficient, that might be a strategy more appropriate for you. If you're interested in Sequoia or any of our other investment strategies, reach out to your Donaldson advisor. If you're not a client of DCM and you'd like to talk to one of our advisors about your specific needs and whether we may be a good fit for you, put a link in the description down below where you can contact us and one of our advisors will be getting a hold of you. In next week's video, we'll be talking about Income Builder, which is our most income-focused strategy. So if you're interested in seeing that video, be sure to subscribe to the channel and click the bell icon so you can be notified anytime we post a new video. Thanks for watching this video, and we'll see you in the next one.